In this video, I'm going to reveal the only 3 ETFs that I would own for the rest of my life if I couldn't buy individual stocks. Now let's start with the first ETF, which is an investment that Warren Buffett would definitely approve of. And that ETF is VOO. Now this is Vanguard's ETF that tracks the S&P 500, which means that buying this ETF gives you instant ownership in America's 500 most profitable companies. Now Warren Buffett has been recommending S&P 500 index funds for years, and I think VOO is one of the top choices to do just that. One reason why is that this ETF is incredibly diversified across the economy. The largest sector in this ETF is information technology with more than a 30% allocation, and other top sectors include financials, consumer discretionary, and communication services. But it has a decent representation of all of the most important sectors in the US economy. Digging into the top holdings of this fund, we can see that companies like Nvidia, Microsoft, Apple, and Amazon all make up very sizable portions of this fund's total assets. Now, this fund has some key numbers that I think make it a top choice. First, the S&P 500 does come with a small dividend yield of over 1%, which should give your long-term return a bit of a small boost. But the real reason I like VOO is because it is incredibly low cost. With an expense ratio of just 0.03%, that is orders of magnitude below the cost of the average fund in its category. And because this fund tracks the S&P 500, the long-term returns have been sensational. Over the last 15 years, a $10,000 investment into this fund would have grown to about $76,000 by 2025. Now, you might be wondering why I chose VOO instead of the more popular S&P 500 ETF, SPY. Well, the reason is simple: cost. VOO charges just 0.03% per year compared to 0.09% for SPY. Now, that might sound like a tiny difference, but since fees compound over decades and these two funds are identical, I see no reason to pay the extra cost to own SPY when VOO is such a fantastic choice. Now, as a side note, VOO is my pick, but the best ETF for you can depend on which brokerage you use. Now, I created an ETF cheat sheet that shows the most popular broker ETFs, as well as a bunch of other ETF visuals. If you want a free copy of those visuals, just visit longtermmindset.co/ETF or click the link in the video description. Now, that brings us to my second ETF choice, which is QQQ. QQQ gives you access to the NASDAQ 100, which is the 100 largest non-financial companies listed on the NASDAQ. Now, you probably know that the NASDAQ has a heavy tilt toward technology companies, and we see that when looking at the sectors. More than 60% of QQQ's total assets are in technology companies, and the next biggest category is consumer discretionary. We see other sectors like healthcare, industrials, and telecommunications make up very small allocations to this ETF. Now, just like with VOO, we see that this fund's top holdings include companies like Nvidia, Microsoft, Apple, and Amazon, but their allocations are even higher given that this fund only owns 100 companies versus 500 for VOO. Now, one downside to this fund is cost. This fund has a total expense ratio of 20 basis points, which is more than 6 times higher than VOO. So why am I bother talking about QQQ? Well, the reason I like this fund so much is because of its long-term returns. Over the last 15 years, QQQ has delivered an annualized return of about 19%, which is 5 points higher than VOO. And to put that in perspective, a $10,000 investment in QQQ would be worth about $137,000 by 2025, which is almost double the return of the fantastic VOO over the same time period. So while you are paying a higher cost to own this ETF, you're being paid in a higher return. At least you have been historically. Now, in the downside, if you invest in QQQ, you can expect it to swing far more wildly than VOO. But that's the trade-off that you pay for investing in cutting-edge companies and growth businesses. The key with buying something like QQQ isn't necessarily that you're trying to avoid volatility. You just have to have the discipline to hold in spite of that volatility to achieve the long-term returns. Now that brings us to our third and final ETF that I would own, and that is SCHD. This ETF focuses on high-quality dividend-paying companies or businesses with strong track records of profits and consistent payouts to investors. SCHD tracks the returns of the Dow Jones U.S. Dividend 100 Index, and this ETF focuses on companies that specifically have high quality and sustainable dividends. Unlike VOO and QQQ, SCHD focuses on sectors of the market that are underrepresented in those indices. For example, SCHD has very high concentrations in energy, consumer staples, healthcare, and industrials, and only a 9% exposure to the information technology sector. Now, this fund's top holdings include blue chip companies like Chevron, ConocoPhillips, Altria, Pepsi, and AbbVie, although the largest position is well under 5% of the fund's total assets. Now, one of the best reasons to invest in SCHD is because of the yield. Since this fund is specifically going after dividend-paying stocks, you're earning a yield of over 3.7% as of the middle of 2025 to add this ETF to your portfolio. That's a very solid cash return that is almost 4 times higher than that of VOO. In addition, with an expense ratio of just 0.06%, this is an extremely cheap ETF to add to your portfolio. Now, as you might expect, the trade-off to investing in an ETF like SCHD is that the long-term returns have not kept pace with VOO or QQQ. If you invested $10,000 in SCHD in 2011, you've earned a solid 12.5% annualized return over the last 13 years, which grew your money into more than $50,000. But that return is 1/3 that of QQQ. Now, in exchange, you're getting a smoother ride and consistent income from SCHD, whereas you're getting just higher returns overall with QQQ. So there you have it. Those are the 3 ETFs that I would personally be comfortable holding for decades. VOO if I wanted broad US market exposure, QQQ if I was going after pure upside potential, and SCHD if I was seeking stability and income from dividends. Now, the nice thing about these 3 funds is you can put them together in a combination that gives you the ideal portfolio for what you're looking for. If you want more upside potential and are okay with a bumpier ride, you can focus more on QQQ and VOO. If you want a smoother ride and income along the way, you can focus more on SCHD. I like the flexibility that these 3 ETFs in particular give you when trying to craft the perfect portfolio for you. Now, of course, just because you know the names of these ETFs doesn't mean you won't do well by owning them. The key to investing in anything that's publicly traded is having the patience to hold them for the long term. Compounding only works if you own assets long enough for them to deliver the returns that you want. Now, as a friendly reminder, I made some visuals that summarized everything that I just talked about with ETFs, and if you want a free copy of my most popular ETF visuals, just visit longtermmindset.co/ETF, and I'll send you a copy right away. Well, thanks for watching this video. I hope you enjoyed it. If you did, give us a thumbs up. It really helps us out on YouTube. And if you want to keep learning from here, I highly recommend you watch this video next.